All right. What's going on, everybody? Woo. All right. What's up, Discord folks and people watching on YouTube and TradingView? I'm going to ask you all, help me get through this. I got to admit, I would have much rather have taken a nap after today. Today was a day to be short. This is the NASDAQ futures right here on the 1 minute. By the way, if we're having any technical difficulties, let me know. Somebody give me a thumbs up, YouTube, thumbs up, TradingView, everything coming through. Good day. All right. Okie doke. Woo, man. Today was I'm just gonna be honest. Today was not a good day for me. It was not a good day. Me being a reversal trader, I kept on trying to get long today. And as you see, that was not the direction to be in. The direction was down. And we'll look at what that means in the broader context on the daily time frame for everything here in just a minute as people kind of spool in. Yeah, that's why I said, come commiserate with me. I mean, usually I come in, I got a lot of energy and excitement. I try to convey that, but man, this job of trading, it's not a job that's easy every day. It's not. Yesterday was a very interesting day. I want to look at that setup. One thing I am excited about this week is we can now on TradingView go back and do bar replay on futures. They must have snuck that on me. There was actually a blog post about this back in January, but I missed it. For the longest time, we were not able to actually do bar replay like in futures. Like here's the 1 minute. This is from yesterday. Yesterday, the trade was right on a timing element of 11:30. I love a setup like this where we have this timing element at 11:30 to go long. This was a fantastic trade from yesterday. And we were trading this live. I'm not sure if anybody was in it with me. I got it late because I was actually busy putting a position on in Coca-Cola, which we'll also look at. But this was the trade from yesterday. Nice, real quick reversal, low risk, was able to get it up. And then throughout we'll let that play out. Throughout the day, went even past the resistance yesterday, Thursday. But then today, man, they gave it up. Here is the level from yesterday. Let's just mark that off. What I've been trying to do is I've been trying to get into a long-term, long contract. Like here's the level right here where, you put your stop below where you got the initial order. But man, they held yesterday's low for most of today, the lizard people. And then right here at the end, last hour, they just gave it up. And so now where we have come to on the daily time frame, we're looking at the NASDAQ. They are, and I say they because I don't believe there's a cabal of secret people. It's the market. It was all of us that are making up the market. But all of us have sold it down into this little range right here. Today, we actually held the daily Tinkinson, basically the daily 50% of the March 3rd to March 8th, the last 2 weeks high. That's about 13,474 on the NASDAQ, or on the S&P futures, the ES, 4278. We basically came up to it the last 3 days, held it to the upside as resistance. And so I got to say, that's pretty bearish. And what I've been saying for the last few weeks here is I'm watching still this February the 24th low that we established in the stock market equities. If we break that 24th low, then I flip bearish. But instead, this week, we just played around. And I know I've insinuated that. I'm not saying I have a crystal ball or anything, but the last 2 months have basically been the story of you can't really comfortably get into long positions. You can't get bullish. It's not that it's necessarily stopping you out. It's just not going the way immediately upwards. So we're still playing around in this danger zone. Cue the Tom Cruise, who hasn't released his most recent movie. So that's where the stock market equities are right now. They are holding above the critical danger zone, but they are staying below that line in the sand, that resistance, halfway point of the last few weeks that would get us into bullish territory. So very, very crazy, choppy, highly volatile, leptocurtic week in the equities. Let's take a quick look at Bitcoin. I know people are going to want to dig into some of the individual currencies. So we'll look at it. And by the way, if you're joining in now, make sure you put in the chat, either just chatting on Discord, TradingView chat, or YouTube chat. What you want to look at. Like I said, help me get through this. If you had a red week, let's commiserate together. It's okay though. This is how we pay for the gains. We could just put our money into a 401k and not look at it, and we would probably be fine. Or we can look for outsized gains, and then we have to take in that fat tail side of risk. So crypto, as much as I hate doing wedges and pennants and flags and all the sort of little diagonal liney things, I mean, everyone's of course going to be drawing this. So this is why I hate it. Where do we draw it from? This low for this low? Okay, let's just do that and call it a day. So crypto, and we're using Bitcoin as the proxy, is just squeezing. Oh, somebody show me this in TradingView this week. Total crypto market cap, of course, which Bitcoin is still the most dominant. This actually looks a lot like Bitcoin, or looks like Ethereum too. But the total crypto market, which I like that because now we can look at an entire index of crypto as a whole, is doing basically the same thing, making a little wedge in that we have higher highs and higher lows. I put out a video this week where I talk about regulation. It was actually yesterday, and how people have been trying to trade Bitcoin this or last few weeks on news. For instance, not everyone, but people were asking me, when Russia invaded, which was back around the 24th right here, is this bullish for crypto, that they're going to use Bitcoin and other cryptocurrency to move around the sanctions? Well, that kicked off a rally, which actually set up a short that was on March the 2nd, which I posted in TradingView. And that made for a nice short trade there. And then, of course, we had this Biden is doing regulation pump that happened right here, which I really got to challenge people's notions about, because I remember reading a Reuters article that stated Bitcoin up on Biden executive order. Well, the NASDAQ on this day, which was March the 8th? Yeah, March 8th, which was Tuesday. Yeah, Tuesday. That was the single biggest day we've had on the NASDAQ. So stock indexes were also up the biggest day of 2022. They're just correlated. Had nothing to do with the Biden executive order. And of course, that bullish news, as some people wanted to say it, it topped out, which was actually a lower high than it made on March the 2nd. And now you are back down here fighting against rising lows. So what did the news matter? It did not. It did not. Very hard to trade on the news. All right. What are you guys looking at today? Good. Hello, everybody. Took some bob calls into the close. If China goes lower, the bottom is endless, in my opinion. Also, webcam, middle of the screen. Oh, I guess I should stop talking. Oh, man. Okay. Yeah, hold on. Let me fix that. Thank you. Because I'm sitting here describing a chart and just talking. Okay. I'm going to stop doing that because I'm going to forget to put in the intro. Okay. So, all right. Let's recap real quick. Russia invasion. People think this is bullish for Bitcoin. Tops out March the 2nd. Sets up a short trade. Good short trade. Everybody says regulation is bullish for Bitcoin. It rises. Does not make a higher high. Now it falls off. News does not matter. technicals only. Look for setups. That's Bitcoin. And Nasdaq. Uh, yeah, you guys didn't see me talking about that morning, did you? Okay. Anyway, equities not yet in the danger zone. The danger zone is the break of February the 24th. That is where we actually have a true breakout. But meanwhile, this week we came up to hold resistance, the daily halfway point, the Tinkinson, between the March 3rd high and the low that we set on Tuesday this week. Tuesday this week was actually a very, very important day for a lot of reasons. All right, let's get back to the chat. Lol. Yeah, exactly. Hey, Discord should be okay. If you're on TradingView, and you look at the live stream, go down, scroll down a little bit, under my name. You should have my Twitter and my yeah, the Discord trading community link should be right there. Yep, in my signature. All right. So look at that big head and shoulder on the screen. Yeah, that's funny. All right. So, yeah, what's up, Josh? So basically, yeah, commodities continue. They continue to lead. Oil has had a very interesting run. I had a friend of mine ask me this week. He drives a lot. He said, "Well, what are some ways that I can potentially hedge my future gasoline prices by using like futures or something like that?" I don't know if buying oil futures is good for the average driver. But what it did actually make me think, what can we possibly do in that case? I think if you are wanting to play oil as far as bullishness goes, there's a couple products. There's USO, which is the United States Oil Fund. That's going to track oil pretty closely, the movements. You can buy this in any kind of stock, IRA, any kind of account like that. UCO, if you want a little more bang for your buck, is the leveraged, the 2x leveraged oil. If you want specifically gasoline, and I learned this to answer his question, that is UGA, go dogs. That is the United States Gasoline Fund. I don't know if that's going to help you offset your gas prices going up, but it does bring up an interesting question. How one could, if you just assume that you're going to have to drive for the next year, and if gas prices go up from here in Atlanta, they're about 4.50 a gallon. I imagine in California they're getting close to 6. If we do get back up in the $5 to $6 gallon range right here, that's pretty oppressive actually. But you could make up that difference in a product like this. And so that's an interesting question. I don't really have an answer for that. But what I will say about oil is, I had a target that I've been talking about in all these weekly live streams and all my weekly videos of 100 that I maintained for pretty much the entire year until we hit it at the end of February. And of course, like most things, when you're in a trade and you take profit, uh, yeah, sometimes you need to have a little bit better imagination, but that's okay. That's okay. It was still a good trade up to 100. The reason I have 100 pegged is because back in history, 100, when I first started trading back in 2013, this was basically the range that oil hung out at, anywhere from basically 114 down to 70. Let's clean up that background. Yeah, so 114 down to 70. I really think that what happens is a lot of, I think, and I both have read that producers, especially U.S. shale producers, become profitable around the $100 a barrel price point. Actually, I need to research that. Let's see. Let's look that up together. So price, hold on, break even oil price by production. See if we can find. I wonder how old this is. Let's do this. Tools. Let's do a time in the past year. Okay. So I want to click. Let's just click on the first one right here and see. This is the break-even price, and this is going to be important because, yeah, okay. So the break-even price for uh, Shelf, which I think that's the off the coast of the um, the Gulf of Mexico. Yeah, offshore Middle East. Yeah, so Russia. I don't know what the shelf is. I'm going to assume that's what it is. Roll onshore. I want to know where the U.S. shale is. Give me a second here. The reason this is important is because this is when producers turn their machines back on. Some of these are a little bit older. Let's see. If anybody's got one of these to look at. Yeah. Okay. So not sure what times to be. This is basically when the oil gets above 70, 80, and up to 100. All these producers start making it because it's actually profitable to do so. And so what you're going to start having as you get higher and higher oil prices is more and more types of producers are going to start saying like, hey, it's profitable for us to produce oil. So I really think that there's a lot of FUD, there's a lot of leveraging, there's a lot of speculation that has pushed us beyond this 100. And at some point, it's going to snap back. But unlike what Kathy Wood has said for many years, I don't believe that we're going to come quickly back down to very cheap oil. I think the more likely situation is that we're going to get back into a range of oil, and that's going to be a range of somewhere from 110 to about, let's call it, 80 at best. Let's say 110 to 90 for right now. So really 110 to 90, I actually think we're going to start to settle inside this range on oil. So what this would probably say to me is we're going to have at least at the minimum $3.50 gas up to 450 over the next few years. In fact, I told my friend, look, if I had a crystal ball, that's what I would tell you, that your oil prices are going to suggest that gas prices are going to be somewhere in that $350 to $450 range here in Georgia, probably a dollar more expensive in blue states. And so if you're considering what kind of vehicle to get, I would think about it in those terms. I would not expect you to see under $2 gallon gas anytime soon. So, and I think I think Biden's press secretary was asked this week, like, what does the Biden administration think about higher gas prices? And they said, well, you should probably have an electric car now, you poors, or something to that effect. It was very let them drive Teslas kind of haughty attitude was the official message, because they're not going to release any strategic reserves, um, not this administration. So don't expect any help from the Biden administration, nor is it really his fault. I mean, what's going on right now is a product of, well, oil 2 years ago was less than zero. So not all trading is obvious, but that oil was going to go up. So anyway, what's going on with XRP? XRP, as far as I remember, they're actually one of the, hold on, where is Ripple is, if I recall, yeah, it's the sixth largest in market cap. So that's kind of impressive. Ripple looks like it's up today despite all crypto, but like the rest of crypto, it's still not really making higher highs. It's making lower highs. Let's see, where's the key highs are, of course, you have the low on February 24th. Yeah, so pretty much it's bullish today, up 8%, while Bitcoin and all the others are down. So that's a pretty bullish sign, but it's not really breaking out. As far as I know, Ripple was really the target of the SEC. I think they're going after the big players, really just to flex their muscle and establish who has dominance over who can do what. Obviously, not doing anything to contribute to the innovation in the space, but just making sure that they know who's boss. And so that's the last I heard of Ripple, was that they were Ripple is basically dictated by their fight with the SEC, but maybe you know more actually. So yeah, what do I think about Atom? Atom is down here. So again, like everything in cryptocurrency, it is caught in a range. I think a lot of people got used to, well, not the last 2 years, because it's the last 2 years as of 2 months ago. I think a lot of people got used to crypto having huge double digit gains month over month. That's not happening now. I think people need to pay attention to that. I'm not going to sit here and dazzle you with, all kinds of fancy technical analysis and Elliott wave theory about when and if it's going to reach the highs that people on Twitter were promising a year ago. It's you're not in a bull market anymore. I hate to tell you. I'm not saying it's bearish. That comes if we break lows. If, for instance, in Atom, if you start to break the lows here, let's call it 20, 21, at that point, you're in a bad shape. Bitcoin, likewise, if it breaks to the downside out of this wedge, because you all know how much I love wedges. Well, really and truly, if it breaks this support, which is the weekly 50% from the COVID low up to the all-time high, if it breaks this, which it has been holding, I mean, I like horizontal lines. It's basically holding the 36K, holding the 45K, getting caught within this range right here. It could very well break to the upside, and that could give a rally. We'll talk about that when, if it happens, where it's going to stop. But if it breaks these lows, that's going to be bearish. The same thing is going on with Ethereum, and so all these individual cryptocurrencies, like Ripple or Atom, as it were, they're all different. Some days will have up moves, like today. Ripple is up 8% when everything's down. Litecoin is up for whatever reason. These things are going to happen. There's going to be divergences, but overall, the bullishness or bearishness of cryptocurrency as a whole is what is at stake. It's Dow theory. Dow theory is one of the tenets of Dow theory, which was applied to the stock market over 100 years ago, is that all the indexes are correlated. They all confirm each other. And so the whole space is being dictated by the same market psychology and sentiment: bullish, bearish, risk on, risk off. And one of the reasons that it's going down is because of the talk about interest rates. What do interest rates have to do with cryptocurrency? Well, like it or not, people have borrowed money to buy cryptocurrency in different forms of financial magic. And so they do that because interest rates have been next to zero. As interest rates go up, that becomes slightly more risky. And that perception of some of this money drying up is what is taking down cryptocurrency as a whole. I had this conversation with another trader on TradingView last night. The real start of the bear market, to me, it began when Bitcoin failed to break out back in November. And I tried to scream to people, this is not good. This is not good. If it had momentum to go up to 800K, it should have gone. But what really put the nail in the coffin, as it were, was this bar right here on December the 3rd. Now, what was that? That was the December 3rd U.S. jobs report. What does the December 3rd U.S. jobs report have to do with Bitcoin? Well, that is what the Fed was going to look at in determining if they should raise rates in 2022. And when the number was good, that meant the economy was good. That means they were probably going to raise rates. And that triggered a stop run, liquidated a lot of people. And now you see where we are today. It has everything to do with interest rates. If they announce a higher interest rate or a faster interest rate rising over the year, that's actually going to be bearish for crypto. So I don't know what is going to be the bullish news that is going to get crypto back up again. But if rates continue to be increased, if there's speculation that rates are going to be increased, that is the prevailing sentiment right now that's dictating stocks. It's dictating cryptocurrency, everything that is a risk on asset. In other words, things that people expect to make money on, big gains, they're doing it on borrowed money, and some of that money is starting to dry up. Basically, we've been playing musical chairs for the last 2 years after COVID, and the music is slowing down. Not saying that we're going to go into a bear market, but that is what is driving the sentiment right now. I don't like it any more than you do. I wish that cryptocurrency would have stayed independent of the existing financial system, but mainstream adoption, right? That's what everybody wants. Everybody wants mainstream adoption and institutional investment because that means that your personal stashes are going to go up in value. Well, it also means that now you're tied to interest rates. So it's a double-edged sword. Can't it's having your cake and eating it too. So yep. All right. Any questions from guys? Well, I guess see people streamed in. Let's take a look at. I'm going to go through my notes right here. There's a few things I want to look at. So let's take a look at a couple of the indicators here. So VIX, see that our VIX expert has joined us there in Discord. I made this note in one of my videos this past week about how the VIX was doing something I'd never really seen before. I think it was like my last weekly video on Sunday nights that I do. So VIX has been doing something that has interested me. And by the way, if you don't know, VIX is the volatility index for S&P options. So it's the fear index. It's basically the perception of fear that's out there in the market. So when the market goes down, the VIX tends to spike up. But then people tend to get over being scared very quickly. And so in a normal VIX, normal VIX, you see a very quick fall off in volatility. People get over being scared really quickly. Even in the COVID crash, which is this big run up in VIX right here, it goes up quickly as fear rises and rises, and then it tends to fall off pretty quickly as well. It can stay elevated, but it tends to go up and then fall off. It has a very sort of, I don't know, what would this be? What would this be? I mean, it's not exactly sinusoidal because that would be more like waves. This is, I don't know. There's got to be some word for it or some animal that does this kind of pattern. But why I think that it's weird now, because again, whoop, down. That's a lot different than what we've seen here, where we had the January 24th low of this S&P, which was a high on the VIX, which fell off pretty quickly. And then we had the February 24th low, which came down and actually made a lower high than January 24th, which is a divergence. Divergences are useful. Even though the markets made a lower low on February 24th, the VIX made a lower high. So there's a divergence there. Now, you would expect that a lower low in the market would lead to more fear, but it did not. So that's kind of a bullish sign. Well, and then this week on Tuesday, March 8th, we again made another run up here with the VIX, another lower high. So that is lower highs on the VIX, which is kind of bullish. But the weird thing is the lows on each day have also been going up. So remember how I said where we should see whoop and then down? Well, we had a whoop and then a Okay, so now it finally broke this chain of lows that it was making. So volatility was just slowly creeping up, creeping up, creeping up, but not really getting higher, higher. And now, finally, yesterday and today, despite the fact the market is down, you actually have VIX falling off. So what does this mean? It tells me bullish, and I'm trying to be very objective about it because naturally my sentiment right now, based on the false breakout of February 24th, is bullish, yet we are coming down to retest these lows. I'm going to read the VIX and I'm going to say that it's telling us bullish, that fear is, while it is still elevated, it is not getting more elevated. So I still believe that the February 24th low is in. But as I said, if you break that February 24th low, you almost certainly will a higher high on the VIX, and that will change the narrative. But that is my read on the VIX right now. Same as it was last week, same as it has been since the February 24th. The low for at least this quarter is still in despite this price action. I've got a lot of direct messages from people this week because I think a lot of people, including me, wanted to see the market rebound very quickly off February the 24th. Well, it's not doing it, but that doesn't mean that the bullish trade is over yet. It hasn't triggered the stop. So we shall see. I know a lot of people, they still think that we're in the process of this 30 to 40% correction because interest rates. And the thesis is that the entire last 2 years of stock market gains are fake. That all this is money printing, and if money printing stops, then the market will return back to pre-COVID levels. Well, number one, the money printing is not going to stop. It's going to be changed from 0% interest rates to 0.25% interest rates. But also, unemployment continues to go down. Companies are actually making money. The economy is pretty strong, actually. And we've got this war going on that, the best we can do is, you know, seize Russian oligarch uh, yachts and refuse to sell them luxury goods and ban the imports of vodka. We're not exactly marching troops in to help the people of Ukraine, nor will we, in my estimation. And so I don't think this is enough to really crash the market. But who knows? It's so funny because the mainstream narrative is put money into your 401k every month, invest, 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 save, 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 dollar cost average. And then the contrarian narrative is no, the market is going down, the market is going to crash. Don't you see? Buy gold, buy Bitcoin. But I hear that so much among trading circles that the contrarian narrative is no, actually, that's just standard FUD that I've been hearing every single day for the last 10 years. It just changes titles. Used to we care about COVID, now we care about Russia. There was this talk of nuclear war last week, which no one really believes. So now there's talk of chemical weapons. It's just something to sell ads. So anyway, off my soapbox there. All right. Peak fear, hard not to be a little bullish. Amen. As a contrarian, I take a look. That's what I'm saying. As I take a look at what people are really focused on, and I just assume that the most people are wrong. Now, sometimes I'm wrong in thinking that because, sometimes people get it right. But actually, I don't know. I don't think people do. I think fear is usually overpriced. That's why options sellers make money, is because they sell that excess volatility, they sell that excess fear. And I think I saw a quote this week, and they put Warren Buffett's face on it. I don't think Warren Buffett said this. I think they just did that to make it hit home. But in the threat of a nuclear war, buy the dip in stocks, because either there is no nuclear war and you make some money, or there is a nuclear war and you don't need the money. So seems pretty logical to me. I look like a Kevin or a Mac. Well, I'm actually a Norok. but you can call me Wes if you know me in real life. Let's see. I'm going back through the text in reverse. Going to trying to find some similar corrections the other day. July 98 SPY correction. I like you, Cole. You go back in history like I do. Let's take a look at that real quick. July 98. I don't know. Do we have SPY out back to 98? Usually when I go back in history, I do DJI. Let's take a look. I'm still operating under the thesis of this year, 2022, is a lot more like 2018 because you follow a up and to the right year that came after an election where you had a unified president and Congress. You had a January blow off, which actually led to a recovery and a higher high in 2018, a higher all time high. But then in October and December, you had a massive uh, drawdown in the market too. I'm singing your thing, Persifying. I like that. Can you put that into a song with like the market in the background? That'd be pretty cool. Yeah, the market's been going up for a long time. Let's take a look at 98, and I'll show you what really scares me. 98 correction. So yeah, I mean this was basically one of the big corrections. Let's see, trying to find some similar corrections the other day. July 98 SPY correction seems possible. Could be totally different. I mean, eventually, okay, so here's the deal. You had a major correction, which is defined by a 30 to 40% movement. And this was like 49% movement in the SPY from the high in February of down to the low of May 2003, a 49% bear market. This doesn't worry me. If we actually entered into a bear market, the opportunities are going to be excellent if you're a trader. And then, of course, we had one a few years later, 07 down to 09. That was a 56%. So these are bad things. And then you didn't really have, you had some a major, excuse me, these are crashes. Crashes are 30% plus. And then once every 2 years, you get a correction. Like you had a major correction here in 2016. And then, of course, in 2018, you had a correction of 12%. Then you had a correction of 20%. And then, of course, COVID gave us a nice 35% correction. The thing about these 40%, 50%, 30% corrections are they tend to happen once a decade on average. So I know that in the moment, it might be a little, arrogant to say this, but it could well be that we don't see another correction of 30 to 50% statistically for another 6 to 8 years. And I know that seems to be like a hard thing for people to really accept, is that the statistics say that we had our once a decade crash 2 years ago because reasons, right? Because reasons. There has to be another crash coming up. If we look at statistics, that doesn't really hold true. Statistics state that once every 2 years, we get a minus 10 to 20% correction. We didn't get one last year. We're getting one now. Totally expected. Of course, the question is this a big one? And, in all of these events, COVID, worldwide pandemic, 2008, financial collapse or potential collapse. 2000, you had the dot-com burst. You also had in here 9/11 as well. And so these bear markets come about through reasons. And I just don't see anything really bad happening right now. Not the whole move, just that 20%-ish sell-off. The 20% seems like a line in the sand, but I agree. 2008 vibes rather than dot-com bubble. Yeah, it really is because the 2008 drops. Let's go back in time to here. These were where is a lot of people that have been trading for just the last 2 years or so. They didn't trade during this market. I did, January was rough for me, but I made it back in puts but come October. And that's why I say I don't fear a bear market, because there's a lot of opportunity and movement. There is. So these were all taper tantrums. This was where the Fed was again talking about raising interest rates, and the market had a fit, a tantrum like a baby. And that's why they call it the taper tantrum of 2018. If you look it up, here's a little market history for it. So taper tantrum. Well, I guess they started talking about 2013, but 2018 was really where yeah. So in okay, so that was actually 2013 it started, and then 2018 was when they started using the term again. Okay, so I'm wrong in my history. It was 2013 it began. So that's what these basically were. And then, of course, in December, this was the day after Christmas. Yeah, so day before Christmas, Christmas Eve, huge sell off. Day after Christmas, I think it was Bernanke at the time. He goes on TV and says, "Hey, whoa, 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 just kidding. We're going to keep the money pressures going," and market rebounds. That was like I think that was up to date on the SPY. The day after Christmas 2018, I think it was the single biggest one-day move in history to that point. I could be wrong, but I think to that point, 4.3% in a single day on the SPY. Yeah, that was a huge rally that comes after big dips like that. A lot of stocks this week actually were doing similar things. I remember Delta I looked at, and I think on what was it, Tuesday? Delta was up, I think at 1.8%. And oh no, it was Wednesday of this week, because there's the close, there was a high. Yeah, Delta was up 8%, but when you look at that 8% off of what, a pretty bearish fall off right there. So yeah, that's what you call it, a dead cat bounce or a bear market rally, whatever you want to call it. So yeah, big up moves happen after big down moves. They just do, and vice versa, as a matter of fact. So is World War III going to happen? I think that's a pretty cool thing to talk about. I think it makes for interesting dialogue and selling newspaper ads. But are we really going to risk mutual annihilation with a country whose GDP is not even 1/3 of Apple market cap? I don't know if we're really going to take that bet. That would be a really, really bad trade to take, actually. So no, I don't think it's World War III. I think that's just cool stuff to talk about. Let's talk about opportunity. I sigh because this is a mistake that I made. Amazon. Amazon. Let's zoom out a little bit. So all these past couple weeks, I have been preaching but not practicing what I preach. My bad. I've been telling people, I talk about my primary fundamental strategy, which is looking for 50% retracements on everything. 50% retracement allows you to pick up Tesla, if however briefly, on the pullback from the May 21 to here, when Tesla pulled back to the 50%, about 900, matched with a past all-time high. That was a good trade right there. Waste management is a trade from 2 weeks ago on February the 24th, where I picked it up off of the 50% retracement from February up to here. I think ExxonMobil was one back in December. These are just off the top of my head. It was a 50% retracement from here to here, and that kicked off. So 50% retracement, 50% retracement. And so I had all the way from, we had an all-time high on on Amazon. We had an all-time high on Amazon July of 2021, back down to the COVID low, which is going to be the low for all these stocks. I had set, was it July? So I had at least 7 or 8 months to sit here and do this simple little drawing tool, and then right click in TradingView or Thinkorswim, add alert at 26.99.56. And it wouldn't have hit it on the 24th of January. It would not have hit it on the 24th of February. It would have hit it on March the 8th, which was Tuesday. That day, that candle right there, you see, not only did the candle close to hold the 50%, it also closed to hold the January 24th low. Go. And that was the support that it held 2 days before they announced the split. Oh, yes, this is money to be made in playing off of the resistance. Yes, this could have been money that I would have, or valuation of the shares I would own. But more importantly, I would have been able to come in here and I would have said, hey, look at this trading view idea. It's not even about me being right. It's basically a validation and me teaching what works, what I believe works in actually trading and investing. I really missed this opportunity to say, hey, everybody, you know that Amazon split you're talking about that's in the news? Well, Tuesday of that week, it pulled back to a key level where, not knowing about the split coming up, you could have bought it just based on that level. And now you'd be in and be getting a 21 and a split on your shares in May. But I'm not going to get all too mopey about it. I'm going to be looking for bullish setups. There was actually a bearish setup. There was a bearish spike today. This, in isolation, if I wasn't bullish on the company, would have been a good trade. And actually, it would have made money because today was such a bearish day. Pulls back right here, stop above the morning high. You may have been able to pull about a 1-to-1 out of it into the close. Who knows? Maybe it'll come down to the 3-to-1. If Amazon comes down to the gap level, yeah, I'm definitely gonna get aggressive there. But Amazon, just like Google, I don't know if it's Google is, of course, my highest conviction trade of the year because of the split that's coming up in July. Why don't I have this marked? So, yeah, I picked up more Google on the 24th dip. So far, it's held as well. Again, the reason I'm so bullish on companies that split is because over the last 2 years, when Tesla split, when Apple split, when Nvidia split, they all had pre-split rallies. And so you have these stocks which are being pressed down by the bearish conditions that we're in right now, but their splits are in May and July. There's still time to go. So I'm going to be looking to play that rally. It may not formulate, but also these are two companies, Google and Amazon, that are not going away. Now, I know everyone wants to take these YOLO calls and really fast money, these zero data expiration plays, but think about, the you 10 years from now. Is the you 10 years from now going to be watching me on YouTube, maybe, if I'm doing this in 10 years? Oh man, I don't want to think about how old I'll be then. Is you of 10 years from now going to be ordering more or less stuff from Amazon? Look, these are tech companies. Yes, they could go away, but I don't think they are. And so I think probably the most obvious trades of our lifetime are some of the things that people think, that's not enough gains for me. What do you mean? Like, how much is, what's the, hold on, year over year performance stock calculator? Is there a quick thing that we can punch in and find out? Thank you, Embrace. I'm gonna start saving the compliments that I have because I need it on today's like today. All right, I'm very critical. I try to be. I read something, or no, there's actually. Let me share this with you guys. There's something I posted yesterday in the everything chat. This is now, you all may be, very confident people. So just don't take the clickbait. I want to post this in the chat actually. Don't take the clickbait that you need to get a pep talk session. This is a guy that's been working at West Point training cadets in confidence for the last 30 years, I think he said. And the key is really, what really spoke to me was he talks about creating this mental, what is it? We call it mental account, mental bank account, something to that effect, of your successes. That's like me keeping my trading logs. I have a huge repository that I keep of, let's see, where is it? Desktop screenshots. Yeah. I've been accumulating a huge screenshot of, these are just on this computer, of all the trading setups that I see on a, day-to-day basis. Like if I see something in TradingView, I take a screenshot. And these are good trades. These are things I see they're interesting. I'm creating that as well. So thank you, Embrace, for that. I'm going to keep that as a positive reinforcement. So I really recommend watching that video I just posted, because it really relates to trading and why you need to save your good trades and learn from, but then get over your bad trades. I'm going to be practicing that this weekend. So let's look at Google. Start month, let's just say we did it from 2020 of March. That's going to be really too good. What's a good start date? Let's just say 2021. January 2021, when everyone was asking me if the market's going to crash. You would not believe the conversations that I had with people. Okay. So, start date, end date, total return 42% if you had bought Google in January of 2021. What about SPY? I don't know if this calculates dividends, but let's take a look. SPY, you are up now 15%. Okay. What about all the popular things that people were trading back in, the COVID crash? The things that people bought into because they wanted really good returns. Zoom, back in January, that you're down 73%. Yikes. Tesla. Oh, you're at break even with Tesla right now. 0.23% since January. Let's go back a little further. Let's just say 2000 2012, 10 years ago, and look at Google. Where are you if you invested? You're up 395% in 10 years. What about SPY? Again, not really. It's probably not calculating for dividend reinvestment. You're up 287%. So Google has very comfortably outperformed the market over the last year, over the last decade. And I have their product. I'm streaming this on their product. I search for everything and they try to sell me things through their ads. I don't know why it's not more obvious to people that you need to own some Google stock. Maybe it's because of the share price, but that's going to be fixed pretty soon. I think it behooves everyone in their long-term investing to really sit down and take stock of what we've learned over the last 3 months, really since November, with this whole pandemic round trip. I think that what people are seeing now is that the fat tail side of risk. People got, myself included, I was in a lot of tech stocks and I've slowly cut them as the last couple of months have gone on, like Etsy. Etsy was a big winner for me. Etsy was a big winner. I really wanted to see Etsy go on to do amazing things. But I made the hard decision to cut Etsy a few weeks ago in when it started breaking this low right here, and now I saw Etsy was down almost 10% today. This has been kind of the story of a lot of things that I come in this videos and tell you guys about. Like, my losers are really making me appreciate what good winners are, like Google and things like that. Like Zillow, I like the company. I bought Zillow when it pulled back here in May of 2021, but cut it in August. And I now have that much more money to put into Google. Again, hashtag not financial advice. Don't buy Google just because I said to, because then I'm going to be liable. But that's the way I've started looking at this. I mean, this has been an education experience for everyone. The reason you got into stocks like, Peloton, et cetera, is because, which, by the way, yikes, Peloton broke the lows this week. people ask me about these things like, what do you do? Where was it going to turn around? And somebody asked me about Adobe this week, and I told them, look, I traded Adobe in this range back in January. This is one of the growth is coming down to buying opportunity phases, and so I bought Adobe, was one of my tech plays, and I cut it a little bit below 500, and now it's coming down past 420. That's just more money that I have to put into better things. I just don't like this whole, buying to own the company. I did that this week. I actually did that. Thanks a lot, Manaconda. Uh, Rivian had earnings, and I decided, I got a friend that's going to work for Rivian. They're opening up a $5 billion facility here in Georgia. I'm interested in owning Rivian as a company. So let me just throw some shares into an IRA. They are now down as of this close about 7%. Don't do that, Wes. Don't do that, Norok. Sometimes I need little reminders to myself, like, nope. Technical analysis. Wait for a setup. Be patient. I need that reminder, but you know what? I'm going to hold on to it. I'm just going to be one of these bag holders because why not? I put in enough so that I can be comfortable not looking at it, and that's fine. That's fine. That is okay. Just like I've got my Donald Trump fun tickets, which sometimes the tree of liberty has to be watered with the blood of paper hands. So yeah. All right. I get dabbed on Peloton. Look, what did people really think was going to come from Peloton? Seriously, like I hope I'm not like knocking anybody that's in pain. I Amer, if he's watching, he told me that he got kicked out of another Discord because someone was having a bad losing day, and he came in there and he was saying like, "Oh, you should have done this, you should have done that." Yeah, don't tell people what they should have done when they're losing money. They're not going to appreciate it. It's not going to be received as constructive criticism. That being said, I've known all my life because my parents they would buy some exercise equipment and it would find its way down into the basement, and after about a month or two it would just not be used. Now I know Peloton is different because it's always different, right? They have a subscription model, which people use it month over month and they pay that subscription. But just the whole premise, the thesis to me that people are going to buy home exercise equipment that is really expensive, and then they're going to the business model is going to be sustained by a subscription model that depends on them to use the equipment. Yeah, that didn't really jive well with me, and so I did not have very much interest at all in buying this stock. It was a great pandemic play for sure, but right around the time pandemic kind of ended, I think that it should have been apparent that this was ended too. So, sorry if you lost money on Peloton, but look, I've been doing this for many years. This stuff happens. One of the themes that I was talking about this year, which has not come to fruition. The theme this year, by the way, has been commodities. But one of the themes that I was sort of looking at is pot stocks. Pot stocks got a great big bump in 2021 after the election of Biden and the Dems because legal weed, yes. Well, that was the narrative, and then it fell off. And it really just has not recovered. But back in the day, in my day, where's Tilray? Back in 2018, was it? Yeah, 2018, man. Woo, man, pot stocks. That was the theme to be in. Wow. That was what everyone was buying into in 2000. Oh, that's February. This is Tilray. There you go. That was a pot stock. And so I think if you're still in some of these pandemic plays, it behooves you to recognize what these type of hype cycles do. They go up, they have their run, they have a lot of hope They have a lot of, people trying to wonder how much lower can it go. There's a lot of people in 2019 that thought, okay, Tilray has stopped at about 80. How much lower can it go? Well, the answer to that question is it can get cut in half. And then at 40, how much lower can Tilray go, right? Well, the answer is it can get cut in half again. So, yeah, how much lower can something go? Well, the answer is 0. So, any last questions before I close it out? Thank you guys for joining me today and keeping me. I'm feeling life now. The weight of the week is lifted. I'm ready for the next week. So, oil stock, the theme of the year. Oil stocks were definitely the theme of the year. Like I said, ExxonMobil. I just happened to be able to pick it up in December based on the technical level, which had nothing to do. He did. I mean, I guess you. I didn't know that Russia was going to invade. Maybe they were launching troops on the border. But this is why I use technical analysis, is because you can't wait for the news to happen to get these gains. I mean, you can. I mean, there's money to be made here in oil as it was going up, of course, but it's not the really good risk reward that you want. So yeah, the theme has been oil. The theme has been wheat, corn, and of course nickel. But honestly, I don't really know how I could have traded nickel. That was an interesting thing. That's such a little niche market that nobody in retail was really doing anything with this. But yeah, nickel, I think for a time was more valuable than gold. So but that's the result of a short squeeze. That's the result of someone getting a little too over leveraged and getting blown out. There's a little big controversy about the London Metal Exchange right now, about how they're giving this guy a pass. But I'm not that really up to date on it. You can read more about that if you want to. Let's see here. NVIDIA. Let's hear it. NVIDIA, I'm still holding NVIDIA. It has been a painful hold, to be sure. So it's just kind of hanging out. But, honestly, I'm not opposed to cutting it if we really start to break this range. The reason I held on to NVIDIA is because of the recovery it did after January the 24th, but it has come back down. I would say that if I had a way back machine, I would have probably just gone ahead and see. I got back into NVIDIA pre-split. So I got back into NVIDIA. Let's see, the split was here. It was right before this earnings, somewhere in this range right here, because there was hold on, let me find it. There was a spike. Where are you? Where are you? Where are you? Where are you? Oh, there was I think it was 2 hour, was it 2 hour, 30-minute spike? We were at this level right here back in May of 21, 50% level that was holding here. So I had a spike that alerted me to it on May the 11th, and I knew the earnings was coming up. So it was a pre-earnings play. And then I believe that on the earnings, in the conference call, they announced a split. And so I held on to it, and then I just kind of let this thing ride through the split. After the split happened, I took some shares off, and kept a little bit more position. And so I had it all the way back from May of 2021. And so now, if I had to do it all over again, I probably would have, as a trader, really done a significant cut on this run up. This, I think it was like an 8% move on earnings right here. When I saw that, I was like, that's day before earnings, something up that much is just kind of like, really, just take your profits. So if I had to do it again, I would, but I'm still sitting in NVIDIA from a May entry, so I'm not underwater. We'll hold on to it. We'll hold on to it. So, can you check out Disney? Yeah, let's look at Disney. Disney is something I own a little bit of myself, but actually, I'm more interested in Disney performing because this is the stock that I've put into my nephew's portfolio. He's 3. So In 15 years, I think that's going to be very good, but I know that doesn't help people that are trading off of this 140 level, which is the level that I like here, because of course that's the COVID low up to the all-time high. We breached it, we came back up, and again, I'm not going to sell it. I'm going to do old school investing where I just buy stocks and forget about them for his 15-year horizon. But like most things, you really don't want it to break this January 24th low because it's at the level right now. And yeah, I don't want it to break this low right here because then again you get into that valley of risk where it could turn around at 120, it could turn around at 110, it could turn around at 100, or it could come all the way back down to 80. You just don't know. I would just prefer not to be in that situation if I'm trading it. But as an investor, like I said, I'm just going to leave it alone. It pays a dividend as far as I know. Hold on, let me check that. So that's another thing I look at when I think about like, can I hold something for a long time? Is does it pay a good dividend? In other words, is the dividend reinvestment, is the money I'm making off of it still pretty decent? In other words, if I had to put my cash into something as opposed to, okay, they don't have a dividend. Okay, so they're a tech growth company. Never mind. Yeah, so you gotta trade it based on the price action. Real quick tangent. Philip Morris has had like a 6 to 7% dividend yield for the last 2 years. And so that's been one of my big, uh, again, hashtag not financial advice, but back since 2020, as a dividend play, Philip Morris has been something I've been recommending because it's something that I have. This is my weed play, by the way, because I believe they bought the third largest marijuana producer in Canada a few years back. So their position, if weed does become legal, but in the meantime, while you wait for weed to become legal federally, you're making about a 7% dividend. So the question at any given point, even when Philip Morris was at, or excuse me, Altria, sorry, MO Morris, but it's Altria. Even when Altria MO was at $43, would I rather have my cash in a savings account making 0% interest and not losing money except 7% to inflation? Or would I want to have that $43 a share in something that is earning about 7% on top of that $43 a share? And so it's a lot easier for me to sit in a big dividend payer and say, like, okay, is my cash better off here or am I better off taking it out? And that allows me to not worry about this too much. And then as sector rotation, which by the way, if you all have not seen it, I did a video this week on sector rotation. I'm going to try to do that quarterly, not monthly. But what is winning? Let's take a look real quick. Let's look actually this last week. What is winning is defensive sectors, your consumer staples like tobacco, uh, Procter and Gamble's, all that good stuff. Actually, is Procter and Gamble still working? Hold on, your Procter and Gamble. No, ooh, that's not good. Yeah, that lost his 50%, didn't it? See, that's an example of something where you got to stop out here. You just saw me go, oops, I should have had an alert there. That's not good. I'm gonna have to address that come Monday. See, J&J, which is the other consumer staple. Meh. So let's see. Last 30, let's see, trading days is gonna be about 20 days in the last month. That takes us, yeah, back to February. So the winners have been utilities. Of course, that's gonna be the waste management play from the 50% off here on 24th. Southern Company is another one. Yep. Duke Energy, Southern Company and Duke are two that I've had for a long time. Again, these also, the reason people are going into these, the reason money is flowing into these, 3.74% dividend yield. I mean, that's high in this market condition for Duke Energy. Southern Company, which is probably even better as the time has gone on, 3.89%. Money, as the market has been going down, has been getting defensive. And it's not that hard to really put a narrative to it. If the market's going down, if these risky assets are going down, people still have to pay their electrical bills. People still have to keep their lights on. And so these utilities, People still need their trash picked up. Waste Management, Duke, Southern Company. They're still gonna, even if the market goes down, even if they go down, they're still paying a dividend. They're still value companies. That's where the money's flowing into, is value plays. Healthcare is another one over the last month. I think UHS. Is it what is it? UHF. UHS is United, and then what is the other one? I can't remember off the top of my head. I have to go back and look. So yeah, those are the things. And consumer staples up until, I think I was looking at this. The last 3 months was doing okay, but as we saw, Procter& and Gamble for some reason is giving it up. Yeah, healthcare. Yeah, REITs. Um, let's see. Is there a REIT that you like? There's one that I have actually. This has kind of been a little niche play of mine. Um, MORT, which is a mortgage REIT. This is something that I've had since 2020 when I had this big sell off. It's basically, you can buy a mortgage backed security. Remember that thing that blew up in 2008? Um, so it gives it was back in 22 and given about a 7% dividend yield. Now it's given about a 6.65%. Again, high dividend yield also implies high risk, but my play here on this was again in 2020 when it pulled back to this level, which as you see is the halfway point of the move down. When it pulled back and did a breakout, I added some there. I think I actually picked up a little more here, which is now underwater, but it's dividend reinvested, so I'm doing pretty well on those 3 buys. And now it has come back again, and it actually set up an opportunity on the February 24th, where I know where my stop is. This is my favorite REIT, actually. Not only because I'm in it, I like the dividend yield, um, and I like the setup, the technical setup here, where it's at. Really, really like this in these past couple weeks. Do you have one that you want to look at, REITs? I mean, really and truly, I don't really focus that much on REITs, but this is one that I do follow because I've been in this for about 2 years after the COVID crash here. So I've been looking at that. Yeah. All right. Well, that seems to be all the questions. Thank you guys for joining me on this Friday. STOR. Last thing. STOR. Oh, is this store capital? What is store? Is that what I think it is? Is it a like for commercial real estate? Company outlook profile. What does it do? What do they do? Internally managed net lease real estate investment of single tenant operation. Store count large REIT investments went to property locations. Profit. Is this commercial? Okay, commercial real estate. You know, I would have to say in 2020, yeah. So in 2020, what's funny is the pattern here. COVID, crash, recovery, pulling back. It looks a lot the same as more. So I bet if I looked at REITs as a whole, they all look basically the same. So investing in commercial real estate was one of the things that I thought was somewhat of an obvious trade in 2020, because if you looked at everything going up back in 2020 and 2021, the one thing that everyone thought was garbage was commercial real estate, because everyone was working from home and nobody was going back into the office. And so that thesis does lend me some desire to want to buy things that people don't think have much value. But it's interesting to see, when I look at a chart like this, I see COVID, recovery, now pulling back. It looks like all REITs are basically doing the same thing. And if we go back to the sector rotation model and we look at where we stand, where this is the theory of where at a market bottom, tech leads you out of the market bottom. We totally had that in 2020. We totally had that in COVID crash. And then of course, well, let's do this. Let's do this. This is fun. Okay, hold on. So let me pull up 2 quarters which is going to be basically 120, let's call it 125 days. So let's go back to 2020, March, let's say April. Okay. So the things that led us out of the COVID crash was tech and consumer discretionary from a market bottom, exactly as the model would predict. And then the next thing you would expect to see is communication services, industrials, and materials. And as we go along, industrials and materials did lead us as well. Okay, everything else, all the defensives, are not. And so as 2021 kind of rounded about, started thinking that, okay, and there's industrials and materials as it continues, started thinking as energy was leading in early 2021, this is a market top. If you're looking at sector rotation, you really got that feeling in the early part of 2021. But then we had this weird thing happen where tech started going nuts later into 2021, and it threw off this whole model. We had a second coming of tech in 2021. But then, as time has gone along into this year, we see energy leading, we see consumer staples. Oh, hold on, let's go. We see consumer staples leading. Now we see healthcare, and now we see utilities. And so the sector rotation model, as we get closer and closer to now, is starting to become a lot more clear that as the market is turning down, consumer staples, healthcare, and utilities are leading. So if it follows that we follow the model, then the next leaders as the market starts to approach its bottom is going to be financials and real estate. So I like it. That is definitely something to watch, is real estate coming up, because if we take it that we've had this run in energy, consumer staples, healthcare, utilities, financials, real estate, that's how the path goes. Again, as I showed you, it is just a theoretical model. It can get thrown out of whack, but it does work occasionally. So just like everything, 80% of the time it works all the time. So all right, covered call strategy. So covered calls are cool. I have been in Kroger from let's see, I bought it on this little inversion back in October of 2021, and I started selling covered calls on it, and I ended up in a covered call going into earnings, which I'm now having to roll out to October. So covered calls are cool, but they require some management. But that's the topic for another video and things like that. So yes, store, perhaps you can get a covered call, but then again, I think you're being a little, the word's not greedy, but you're getting a 6%, or hold on, what's the dividend yield on store? 5% dividend yield on store. That's pretty good. And then you're going to sell covered calls against it. You're going to make even more yield off of it. The word's not greedy, because I don't think anyone's wrong for being greedy, but yeah, you're asking for a lot out of it. I'm not saying it's bad. It's just, you're already making money off of it, but okay, you can make more. So yeah, I like it. It'll work. Let's see. All right. What else? Is that it? Can we look at, oh yeah, ATVI. Okay, sorry. Okay, am I not reading Discord? Yeah, ATVI is another high conviction trade of mine. So the reason it's a high conviction trade is because Microsoft announced on January 18th that they were going to buy Activision Blizzard for $95 a share cash. Okay. So what does that mean? That means that on or before, the latest being June 2023, they are going to purchase Activision Blizzard, every share that's outstanding, for $95. So what that sets up is a merger arbitrage. And I posted about this back when it happened. I went ahead and jumped into it a few days after it happened, which was probably around like 80, 81, something like right here. And of course, when we had this market sell-off, so too did Activision sell off. Now, I learned because I'd never done merger arbitrage before. This is a strategy that people in white hair and suits and stuff like that do a lot. So I was just trying to figure this out. I did it by buying shares. I also did it in a vertical call spread, vertical call debit spread out to 2023. And so as this market has come down, if I had been patient, probably could have picked up Activision off of a technical level, maybe picked up something here late January, waited until we had a big market dump like we did on the 24th. So patience would have paid off. That's the one thing I would change about Activision Blizzard. But my fundamental strategy here has not changed. There has been no news that has come out that said, no, Microsoft is not going to buy them. There's been no news renegotiating the deal. Nothing has really fundamentally changed with the trade, as it were. And really, the price action you see here is really what you expect to see from a merger arbitrage. Pretty much nothing. In fact, we have, where's the 24th of February in here? Yeah, you had a little dip in here, but nothing that's going on in Russia, nothing that's going on in the world. Nothing that Activision Blizzard does, if their latest World of Warcraft expansion flops, it doesn't matter. Microsoft has already agreed to, and the board has already signed off on, a $95 a share purchase. That, unless that changes, these shares are still worth $95. They just happen to be trading at $80 a share right now because it's not for a year and a half. And you think about that, what is the difference here? The trade is basically putting your money into this opportunity. You're putting, let's say, $80, and you're expecting over the next year and a half to make 18% return on your $80. That is the trade. And so the question is, okay, well, the stock market last year returned, was it like 24%, the S&P did? So if you look at it this way, it's basically an 11%, maybe a little more now, 12% annualized return on your money. Like, can you get that somewhere else? Well, maybe. You could probably put it in Google and get better. But though it's not guaranteed, that's how you have to look at it. This is putting your money into something with an expected return, where the risk is, of course, that it doesn't go through. Worst case scenario, you end up bag holding Activision Blizzard shares. But you're expecting a return on your money at the end of this period when these shares are bought. And that hasn't changed. And so what you should see happen over the next 2 years is you should see a very slow, tight rise in price up to that moment. Actually, it'll actually look more like this. It'll actually look more like it'll rise quickly, and then as it gets closer and closer, it'll fall off. So yeah, that's more what you should see in price on Activision Blizzard. Because we've had all these wild swings, but really, what has Activision done? Well, it has settled around where people think that it's worth the risk to put their money away, and that's where the trade stands at right now. So I think you said that it was a lower weekly close. Well, honestly, yeah, you can have a lower weekly close, but if I'm using technical analysis here, what I see is the launch point of this bearish move, which was in June of 2021, down to the low of November. You have this halfway point, which again, boom, it held. It's also a nice little inflection point here. So if for some reason we get a close below 78, at that point, if I can't find out what is wrong, like in other words, if no news has come out, that will almost make my conspiracy theory senses say, okay, somebody knows something. Somebody knows that this deal is not going to go through. And so that would be the technical line in the sand that I would actually be concerned about. So that would be my answer to the Activision trade. As it stands right now, a purchase of Activision shares, as it stands at $80.31, offers you about an 18% return in 18 months. or 17 months, whatever the case is, math. I'm not worried about it until it breaks below 78. If it does that, then something else is going on and I need to pay attention. So that is the Activision trade. So thanks for bringing that up. I know that Jen asked for that as well in the live stream notes. So yeah, any more questions before we close it out? So let's see. Checking the things. Yeah. All right. That sounds like a wrap. Have a good one. Have a good weekend, everybody. Do something good for yourself. I know I'm going to, and come back next week because we are not bearish yet. And if you've got stuff that you like, if you've got companies that you like, they're probably at lows. Don't buy into the fear. There's something going to come out this weekend about Russia doing something. The news media is going to milk this for all it's worth, and then when it goes away, there's going to be a new COVID variant. So just do something good for yourself. Look for opportunity. Trade wisely. We'll see you next week.